we are battle tested. That's one of the great things about our company is that nothing catches us up by surprise. And it comes from a culture of continuous improvement and innovation. And we practice and we drill. And we've had, 49 hurricanes in the last 20 or 30 years. We're never caught by surprise. We're a company that is used to managing through diversity, and that's one of the strengths.
So you mentioned catch by surprise, and I mentioned the stock price in the last couple of days. So there was an investor presentation that you made, and where you outlined your forecast this year through 2026. You're also 2027 midpoint profit forecast. That's the one that analysts said that falls short of our estimates.
Yeah.
And I guess the question is, if data demand and data power is going to drive so much demand for your stuff, why isn't that midpoint higher?
Well, here's what we see, and we talked a lot about this at the Analyst Day yesterday. There are three things that I think really differentiate NextEra as part of our value story. One, we're seeing an inflection point in power demand. Two, it's going to be met by renewables because it's low cost, fast to deploy, and it's clean. And no company's better positioned to meet it than we are. And our business model has always been what I would call a replacement cycle. We are building new renewables to replace higher cost coal plants, higher cost, less efficient gas-fired units, oil-fired units. We now have this new opportunity that's really emerged in the last 6 to 9 months, which is what I call our growth cycle opportunity. It's a new demand that has come, and it's across industries. It's not just data centers get a lot of discussion, but it's industrial electrification, reshoring and manufacturing as well. But when you think about it, we're having all these discussions with these customers now. I'll take data centers, for example. It takes 2 to 3 years to build a data center, so they won't need the power until 2027. We might sign a contract today, but the power comes in 27, which means it contributes in 28. And so what we were trying to explain to investors yesterday is, look, we have a tremendous long-term growth outlook, but a lot of this growth cycle demand is really going to start materializing and producing revenues and earnings in 27, which means it really starts to contribute in 28.
As you walk through Midtown Manhattan, you probably see some empty office space here. I think they all moved down to your state. Talk to us about how that's impacted your business in terms of demand and maybe what you have to invest back into your grid.
Yeah, and that's what's great about our business, right, is the barbell approach. We've got the nation's leading rate regulated utility in Florida and the world's leader in renewables. In Florida, we're seeing tremendous growth. Over the next 20 years, we're projecting a 44% increase in GDP. We have 1,000 people a day moving to the state of Florida. 4 of the 5 fastest growing metropolitan areas in the United States are in Florida. If Florida were a country, it would have the 14th largest economy in the world. And we're there to power all that growth. So our growth story is not only about what I just discussed about all this renewable demand that we see power in AI and industry and manufacturing across the United States, but it's also all the growth that we see right in our own backyard in Florida.
Talk to me about rates. So you're going to need to invest a lot, right? Like there's going to be an enormous investment cycle, as you mentioned, like the growth cycle for utilities, right? What is it like on the regulated side of going back to the government and saying, okay, guys, I got to invest it. You got to raise the rates.
Yeah, and so what we do is we have done a terrific job of taking cost out of our business. So when you look at what we've been able to do over the last 20 years, our O&M on a dollar per megawatt hour basis is 70% lower than the national average. That's $3 billion we put in our customer's pocketbook every single year compared to an average utility. And we've always been able to make really smart capital investment decisions around bringing low-cost generation into the fold. And today, the lowest cost generation option that we have in Florida is solar and storage. So although we're investing more capital, it's actually lowering the bill because it's a lot cheaper than other generation alternatives, combined with our ability to take cost out with the way we operate.
But from your investor's perspective, is a unit of power from a renewable source, what's the profit margin on that versus maybe an existing source?
Well, when you think about renewables, I mean, renewables, have really strong returns. And they're low cost, and you talked about interest rates being one of the factors. We pass those costs through to our customers, and so the cost of wind and solar has gone up a little bit as we've seen some pressure here from the macro environment, but so have cost increase for every other type of generation. Actually, gas-fired generation has really gone up in price. And so, what we have seen with gas-fired technology is a 50% increase in the last 12 months. That has not happened to renewables, making renewables even lower cost than they've ever been on a relative basis to gas turbine options.
So what I hear is that everything is just more expensive because that's the environment that we're in. But because you're able to take costs out, the ratepayer may not get hit as hard. Is that a fair statement?
That's exactly right. And so what we've been able to do in Florida, our bill is 37% lower than the national average. 37%. It's because of our ability to take all those costs out of the company and also offer them low-cost renewable solutions as part of the generation mix. And when you put those two together, that's how we're able to achieve that 37% lower bill than the rest of the nation. That's a really compelling customer value proposition and investor value proposition.